Can you invest in ICICI Prudential FMCG ETF fund? This is something unique fund which came up in the last couple of years, we can say, and also for ICICI, this is not something new what they are doing it. More about this fund in this ETF in this video. Hi, hello, this is Ganesh Santhiru, your stock market profit coach and author of the book One Page Stock Market Plan and Money Leaks. I help in multiplying your money by investing in stock market. So today's video about this ETF, new ETF which has been launched, and why I say this is not new for ICICI, because they launched ICICI Prudential FMCG fund, which is something unique they launched in 1999, and the same thing they launched with ICICI Prudential IT Technology Fund. So something again unique, a sectoral fund when nobody was launching such things. SBI has launched Pharma Fund during that time, but ICICI was something like two sectoral funds at that time, and there are so many thematic funds. So again, in index category, ICICI come up with the first index fund, and specifically for FMCG ETF. So more about this fund today, and the first thing is, what is the NFO period? It started on July 20th, a couple of days ago, and it goes up to August 4th. And more about this video, and what are the constituents, what is FMCG? FMCG is nothing but fast moving consumer goods. Fast moving consumer goods are nothing but the products whatever you're using in your daily life. After getting up in the morning, what you will do? You will brush, that is good for your health, good for your family, right? And after you do what you will do? Maybe you will go and have some snacks, and along with the tea, coffee, a biscuit, and tea, coffee, right? Tata tea, Tata coffee, Nestle coffee, right? Along with some biscuits from ITC Sunfeast or Britannia Marigold for tea, and that is what they do. And if you go and do your hair oil, if you put your hair oil, it is from Marico, which is Marico, which is parachute hair oil with Marico, or Dabur Vatika. And Dabur also has toothpaste along with Himalayas not listed. So all these are companies which are listed in stock market, and along with a few other companies which are in the top. And if you go for Three Roses Tea, which means Hindustan Unilever, Brew Coffee is from Hindustan Unilever, and Pepsodent is from HUL. So all these are bigger companies. So if you got the fair idea, right? Whatever you're using in your daily life, that is what you're going to invest in this index, this newly created fund. And they are going to copy something like the same thing. These are the companies they are going to invest. Almost, if you look at the major weightage, almost close to 30% is with Hindustan, and remaining 23% is ITC. Almost, if you look at we have 10 to 15 companies which forms part of this index constituents. So if HUL is moving, this fund will give extraordinary returns. If HUL is not moving, because in the last 1 year HUL didn't move, so the last 1 year returns I'll show it to you immediate right now. And if you look at, if Britannia is even giving extraordinary performance, as the constituent is just 6%, this the out of the everything put together, this index performance may come down. Okay, so this is the advantage of ETF. You're not going to change. Almost these 10 to 15 companies is going to stick, and over a period of time, you will this every 6 months the rebalancing will happen, and everything will keep changing. And you have seen the constituents, and just look at comparing the FMCG total return index with Nifty 50 total return index. And the most important and staggering fact is that even during the slowdown period, minus 23%, FMCG index had gone up by 10%. And 2012, there was a growth in Nifty index to 29%, whereas Nifty FMCG has given close to 50% of the returns. And whenever there is negative returns in Nifty 50, this FMCG has given positive returns. These are all because of the backtesting method which they implemented. And just look at 2018, 5.6% was Nifty, whereas FMCG performed 16%. And in 2020, it was almost on par, but 2021 till date, it was very low. Though Nifty has given 16% from the bottom, most of the companies have given extraordinary returns. But what is important is that across the market cycle, this fund, this FMCG can perform like anything. So if you are someone looking for constant returns, in the sense like, say, about 10, 12 to 14% or 15% returns over a period of time, and then you can go for this. Let's look at the performance CAGR. As I said, 15% in 10 years timeline, 5 years 12.5. Just look at consistent returns at any point of time. You will feel like you are getting some good returns in this fund, in this index. That is the advantage of putting this money in this index. Just look at FMCG as well as Nifty 50 TRI. You may not see extraordinary, but if you want something like standard returns, I don't want so much risky. I'm the first time investor, maybe go for it. You may not see negative returns, but you will see some positive returns. And even when Nifty is performing extraordinarily, this fund may not perform extraordinarily, but you will see good returns over a period of time. And finally, what you expense ratio, and as it is an ETF, the as of now they what they are saying is 1% is the expense ratio, as it is an exchange traded fund. And when you compare the exchange compare the expense ratio of ICICI Prudential FMCG sectoral fund. There is something called, this is ETF. What they are launching now is ETF, and they already have for last 20 years they launched ICICI Prudential FMCG fund, and that the expense ratio of that fund is around 2.47 percentage. So that is the kind of returns this fund has given in the last. Let me show you the portfolio and how much returns it has given since inception. By just let's go and watch out here. I'm just going to show you. Hope it is clear right now. This is ICICI Prudential FMCG fund, which is already in the market. Just look at the, it is almost on the top of the annualized returns is 16.36% since inception, whereas this category average is 15.37 percentage. Okay, so whereas what we had seen in the 10 years returns is here 14.24, and our fund ETF is going to give you around 14.9. That is not going to be a much bigger difference, maybe around 0.6 percentage. Let's look at the portfolio. This portfolio, if you look at, there are more than 25 companies, whereas in index it is going not more than 10 to 15 companies. And if you look at even in FMCG, ITC has 22% and HUL is having 16 17 percentage. Both put together, the index is this fund itself is having 40%, whereas ETF is going to occupy more than 53 percentage of these two stocks alone, and remaining Britannia is going to occupy the same point. United Spirits, here it is close to 5.5%, whereas in ETF it is going to be around somewhere close to 1.5% or something. So if you look at, there are many other FMCG related funds which they had invested in this FMCG fund, whereas in ETF it is going to be of in ETF it is going to be of very limited only up to 10 to 15 stocks, not more than that, and it will be a rebalancing will happen once in 6 months. That is the reason of ETF, which is a passive fund. So choose which one you want to go. The returns are not going to be a major difference, but if you are a fond person of passive investing and index funds, maybe a index and add a FMCG index in your portfolio, it can give you around 14.5 to 15% in 5 to 10 years timeline. So this is how you can plan your mutual fund investment portfolio. Thank you so much for watching. Please share this video with your friends who are asking about investing in an NFO with detailed analysis. Thank you so much.